Welcome back to Investing Talk Podcast.
Today we're looking at Richtech Robotics. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We are examining Richtech Robotics, a company dedicated to service robotics, which is, well, a massive, pretty untapped market.
Right.
They specialize across sectors like hospitality, commercial cleaning, and healthcare. The immediate focus here, and maybe the reason this stock is generating such excitement, is the incredible projected growth trajectory they're currently signaling.
Okay, yeah. When we look at the source material, the growth numbers are genuinely compelling. Analysts are forecasting, a consensus revenue of $13.48 million for fiscal year 2026?
That's the number.
If you stack that against the $5 million projected for the current fiscal year, 2025, that is a jaw-dropping projected 175% growth year over year.
Exactly. And that leap isn't just growth. It's what analysts often call a massive inflection point.
Right, the point where things really take off.
Precisely. It signifies that moment a tech company moves past maybe the initial R&D phase, where they're just proving the concept, to the full-scale commercialization phase.
Where they're actually selling and delivering.
Yes, fulfilling large purchase orders, scaling up production. For a robotics company, moving the needle by that much suggests real market adoption is kicking in.
So that exponential growth potential certainly drives the current, $1.21 billion market cap. But, okay, we have to ground that potential in the current financial reality. How does their balance sheet look right now?
Well, it looks exactly how you'd expect a high-growth disruptor to look. They are firmly in heavy investment mode.
Meaning losses.
Oh, yeah. They reported a net loss of $4.54 million in the most recent quarter. And when we break down that loss, their operating revenue was only $1.17 million.
Oof. So expenses were running close to $6 million for that period.
That's right.
$6 million in expenses against barely over $1 million in sales? That is a serious cash burn.
It is.
For our listeners who might not be deep into financial statements, where is that cash typically going in a robotics firm like this? Is it R&D, building inventory? What's the main driver?
It's likely a mix, but primarily it's the cost of scaling. Think about it. High fixed costs for manufacturing physical robots.
Right, the hardware.
Specialized labor for installation, maintenance, and critically continued investment in the AI and software side. Plus, they're building out sales infrastructure to handle that projected 175% growth next year.
Ah, okay, so you have to spend money today to secure those massive contracts tomorrow.
Exactly. They're sacrificing that short-term profitability for market share. It's a common strategy in this space.
Makes sense. But the trajectory matters, doesn't it? Are analysts expecting these losses to keep widening, or are they, tightening the belt?
The trend looks positive, actually. The consensus is that the losses will narrow. They're trailing 12 months, or TTM, EPS.
Earnings per share over the last year.
Right, that's currently negative $0.15. That's expected to stay about the same for fiscal year 2025.
Oh, yeah.
But by 2026, those projections show an improvement, forecasting a loss of only negative $0.10 per share.
So getting closer to break even.
It suggests the market believes they're approaching what's called operational leverage.
Okay, operational leverage meaning their revenue growth is finally starting to outpace how fast their expenses are increasing.
You got it. And that trend is really vital for justifying their high valuation.
Okay, but let's look at the core value proposition. Why Richtech Robotics specifically? What's their competitive edge that justifies, a $1.21 billion valuation over other robotics firms?
I think it comes down to two main things: product breadth and a strategic focus on margin. Their product line is unusually wide for an early-stage robotics firm.
Really?
Yeah, and that diversity significantly de-risks their business model, you could argue.
That's interesting. What specific products are we talking about?
Well, we see everything from the highly publicized Atom AI barista and cocktail robot. That's kind of their headline product right now.
The flashy one.
Right. But also the utilitarian and high-demand commercial robots, like the Scorpion floor cleaning robot, the Titan for large warehouse payloads, the Skylark for hotel room service, and the Medbot for hospital deliveries.
Wow. Okay. So they aren't just selling like a novelty cocktail maker. They're selling a full-stack automation solution across multiple verticals: healthcare, logistics, hospitality.
Precisely. That means if, say, the hospitality sector slows down, they can maybe lean more into commercial cleaning or healthcare. Plus, their strategy seems centered on AI-powered personalization.
And that allows them to charge more.
It seems so. It allows them to command a premium price. Their flagship products typically retail between $18,000 and $25,000.
Not cheap.
Definitely not. They're aiming for quality and high margin, not just winning the race to the cheapest robot. And that potential for margin expansion is what gets long-term investors really excited.
Okay, so we've covered the phenomenal growth projections, the unique business model, but let's flip the script now. If the stock has soared and the narrative is this positive, what's the single biggest impediment? The major risk that prevents this from being, say, a 10-10 investment thesis?
Well, there's always risk with execution. Scaling complex robotics is tough. But perhaps the most pressing concern, the critical caveat, and this is something every diligent investor needs to be aware of, is the lack of easily verifiable foundational balance sheet data.
Explain that.
We mentioned the cash burn, right? But without direct, readily available SEC 10K or 10Q filings, crucial liquidity data points remain sort of unconfirmed in the aggregated information we have access to.
Okay, that sounds like a potential red flag. For listeners who hear SEC 10K and 10Q, those are the mandatory annual and quarterly financial reports required for publicly traded companies in the U.S., correct?
Exactly. Those documents provide the validated, audited numbers on things like exact debt levels, cash reserves, working capital, crucial stuff.
And for a company that is currently burning cash at a rate of almost $4.5 million per quarter, knowing their runway, how long their cash reserves will actually last, is absolutely vital.
Couldn't agree more. We have to treat the liquidity and leverage ratios as basically unconfirmed until those official filings can be properly scrutinized.
Okay, but if we can't verify the exact cash reserves, why is the market still assigning this company a $1.21 billion valuation? Doesn't that risk maybe outweigh all the exciting technical and growth data?
It's a great question. It really comes down to market philosophy, I think. Investors are making a calculated bet on the total addressable market, the TAM, for service robotics.
They think the potential market is huge.
Enormous. And they believe Richtech Robotics' product breadth is so disruptive that the current price is simply a highly discounted valuation of future cash flows. They're basically saying we accept the current execution and financial risk because the potential upside if they achieve even, say, 5% market share is worth the gamble.
So a bet on the future.
Definitely. But you're right, if those official filings eventually reveal serious balance sheet stress, the stock could drop significantly regardless of those future revenue projections.
That's the balance every high-growth tech investor has to weigh, potential versus verifiable reality. Okay, let's assume the market is right for a moment and the cash runway is sufficient. Shifting gears, how does this high-risk, high-potential scenario look on the technical chart? What's the price action telling us?
Well, the technical momentum is undeniably bullish. It signals that buyers are currently winning the narrative fight, so to speak.
Okay.
The stock is trading well above its major moving averages, the 50-day, the 100-day, and the 200-day.
And trading above the 200-day moving average, that's usually seen as a pretty strong sign of long-term health, right? Indicating the stock is in a persistent uptrend.
Generally, yes. That's a key long-term indicator many follow. As for the immediate setup, if we unpack that, the technical picture looks pretty favorable for continued upside, actually. The stock has been consolidating.
Meaning trading sideways in a tight range.
Exactly. Trading sideways in a tight band, roughly between $5.52 and $6.14. Consolidation is often viewed as the market kind of digesting recent gains, maybe collecting energy before the next major move.
Okay, and what's the significance of that $5.50 mark you mentioned, at the bottom of that range?
That appears to be a crucial support level. After it rebounded strongly from earlier lows, that $5.50 price point seems to represent a price where a significant number of strong buyers stepped in.
So if it holds above that?
If that support holds, it provides a solid foundation, technically speaking, for the next upward push. Right now, the stock is trading right near the consensus analyst price target of $6, which suggests the market might be waiting for some new information, a catalyst, to break out of this consolidation pattern.
Okay, so what is the spark? What are the near-term catalysts that could provide that new information and trigger the next leg up? Push us past that $6.14 consolidation ceiling.
We actually have several high-profile catalysts arriving pretty quickly. The biggest recent announcement was that partnership back in October with the Vegas Golden Knights professional hockey team showcasing the Atom robot.
The hockey team. Why is a partnership like that so important for a robotics company? It sounds like marketing maybe, but is it more strategic than that?
Oh, I think it's absolutely strategic. It's high-profile, non-traditional B2B exposure. Think about it.
Okay.
The official gala debut of the Atom robot is set for November 2nd. This isn't just some trade show. It's a premier venue. High net worth individuals, large facility operators, entertainment executives, they'll all be there.
Ah, so it's a live demo for potential big clients.
Exactly. It serves as a live, high-volume operational showcase,
Mm-hmm.
which is way more valuable than a controlled demonstration in a lab somewhere.
Gotcha. And fundamentally, the most critical date coming up has to be the Q3 2025 earnings report.
Correct. That's expected around November 14th, and this report will be scrutinized for two main things.
Revenue beat or miss.
Did they beat their revenue expectations? Yes. But maybe more importantly, did they raise their guidance?
Right. Future expectations.
For a growth stock like this, a guidance raise meaning management expects future earnings to be higher than they previously communicated. Can be a huge driver of momentum. A strong report could easily reignite the kind of rally that saw the stock jump over 11% following their last major product announcement back in August.
Okay. And outside of the confirmed events, there's always market chatter, right? Rumors. What are the interesting but, unverified rumors we should maybe be aware of?
Yeah, we should always acknowledge the speculative environment surrounding these kinds of stocks. One circulating rumor is the potential expansion of that Atom robot concept to other professional sports leagues following the Vegas partnership.
Makes sense if it works well there.
If this partnership is successful, yeah, the rollout could be massive. Huge potential there.
What about the tech side? Are they looking for partners to help them scale production or maybe improve the AI?
Well, there are persistent rumors about a potential strategic partnership with a major technology firm. The logic is pretty clear. Richtech Robotics has proven hardware and placement. But a partnership with a firm specializing in core AI infrastructure or global distribution could seriously turbocharge their ability to meet that projected 175% growth.
Right. Leverage someone else's scale.
Exactly. And finally, there's the trend of institutional accumulation. While it's not yet confirmed through official 13F filings.
Reforms big funds have to file.
Right, but the rising trading volume and the resilience of the stock price kind of suggests that larger players might be building positions quietly. It's market chatter, but it's there.
Okay. So if we synthesize all of this, the massive growth projections, the premium product breadth, the strong technical setup, these upcoming catalysts, against that major risk of the unconfirmed balance sheet data.
Yeah.
Where does this leave us on the central question? Is it a good time to buy Richtech Robotics now?
Well, the overall investment thesis, based purely on the material we've examined, it remains strongly bullish, which is why it gets that 8 out of 10 rating we saw. But it's definitely a high-conviction, high-risk play. No doubt about it.
So for the short-term trader, maybe someone looking at the next few weeks.
For them, the stock looks attractive right now, based on that technical consolidation pattern and the clear timeline of upcoming volatility events, the November 2nd debut, the November 14th earnings. The risk is pretty well defined by that $5.50 support level.
Okay. And for the long-term growth investor, the buy and hold type.
For them, Richtech Robotics looks positioned beautifully to capture a significant portion of the burgeoning AI-driven service robotics market globally. They seem to have the right product strategy, that diversity in premium pricing.
Assuming,
and this is the big if, they can successfully navigate the execution challenges and, crucially, manage that cash burn effectively until they hit profitability.
Yeah. The fundamental truth here seems to be that the market is valuing a future that hasn't fully arrived yet. They're betting on the successful execution of those really ambitious growth projections.
Absolutely. So I think the key takeaway for you, our listener, is that while the growth story and the technical setup are compelling, this investment thesis is built heavily on trust and projection right now. That means the next layer of diligence, the responsibility of checking those foundational documents, specifically the exact balance sheet details and official filings, is mandatory the moment they become public. Everything else is kind of secondary until you confirm they have the cash to survive that transition to profitability.